right? So this is what this trade looks like now. We are in a May expiration, long 120, short 130. We've been in this trade for 5 days. Stock has moved one standard deviation to the upside. Volatility came down a little bit. We're currently showing about a 30% return on risk, risk being debit paid for this trade. Right, so the trade was put on for about a $5 debit or $500 per one spread. Right, so risking 500 to make 500. Now both options are in the money. There's still 51 days to go. As I mentioned earlier, we're currently running into a potential level of resistance. I don't think we're going lower, but we are probably due for some sideways consolidation. Or if the stock is just going to stall here, what can we do to actively manage our risk? And when I say manage our risk, how do we reduce our potential or our capital that is at risk? If the stock was to go down, how do we prevent ourselves from losing money when we don't have to? Now, if it continues higher, that's great, right? But if we want to pull some of our risk out of this trade, we will have to give something up in exchange for that, right? You can't have it both ways. You have to give and take. So if we want to get rid of some of that risk, we will have to give something up for that. What I'm thinking here, as I always say, the best way to manage any trade that is up 20, 30, 40% with plenty of time to go, you could always exit. If you do get a pullback and you're still bullish, you can always put it back on. Or what I would consider doing here is I'm going to look at May expiration, and I want to know what option market is pricing in for May expiration cycle. Right, so we can look at the price of an at the money straddle, right? We add the value of an at the money call to the value of an at the money put. So we have about 17 points is what the market is pricing in right now. I'm looking at Thinkorswim, and Thinkorswim says that May expiration is pricing in plus minus 19.5, so about 20 points. So what I would want to do is I will go out, right? So the market is pricing in a move of about plus minus 20. I'm going to go out just short of expected move, right? So I'm going to go to about 150, or we can just look at the delta of this option, which is 25. And I'm going to sell a 10-point wide call spread against my long 10 wide call spread, converting this trade or converting this position into a call condor, right? So selling a 150, buying a 160, right? Now I will have two spreads, right? I will have a long call vertical and a short call vertical. They're both 10 points wide, so they're balanced. Okay, so I'm going to sell to open 150, 160. It's currently going for about $1.50. So I'm bringing in $150 credit, and that credit will go towards reducing my risk, right? If I paid $5 for the 120, 130, and now I'm collecting $1.50 for selling the 150, 160, my risk goes from $5 to $3.50 or $350 for this position. So I have less risk, but what did I give up in exchange for reduction of risk? I gave up some potential upside here, right? As we can see, the T+0 lines, if I did nothing, right, my T+0 line continues to just point higher. So the higher the stock goes, the more money this call spread would make. Since I'm selling a call spread here, I'm short a call spread, which means that if the stock continues higher, I'm going to have some losses here, and some of those losses will be offset by the gains in a long 120, 130. So my T plus 0 line is kind of flat on the upside. So I'm giving up potential upside in exchange for reduction of risk. So now if the stock pulls back, I can buy to close the 150, 160, and once again, I will be left with a 120, 130 with enough time to expiration. If I'm still bullish, as it goes higher, I may consider selling another call spread, and I will trade around my position here at 120, 130 to reduce cost basis as much as possible. Right, so that's something to think about. Again, the simplest, the easiest way to reduce risk is to exit the trade and wait for a pullback. Or instead of exiting the trade, we can sell a call spread to kind of neutralize our position. If you look at the Greeks, right, my delta before an adjustment is plus 17. And if I sell the 150, 160, that will take my delta down to plus 7. Which means that if the stock continues higher, for every 1 point that it goes higher, I will make $7 instead of 17. So I'm giving up my upside in exchange for less risk on the downside. And I'm at the same time introducing risk to the upside now, which means that if AMAT runs to 190 next week, obviously this position is going to be in a little bit of a jam. So that's my idea, guys. Something to think about. I'm going to sell to open 150, 160 in May against my 120, 130. Hopefully this makes sense. If the stock pulls back, maybe I'll make another adjustment. Best case scenario, we sit on it for about a month. Nothing happens, and we're somewhere between 130 and 150. Obviously, both spreads are going to work in our favor. The 120, 130 is going to appreciate in value, while 150, 160 short call spread is going to decay. We're going to make money from both if the stock just kind of sits somewhere between 130 and 150 over the next couple of weeks. So that's my idea. I hope this makes sense. If you have any questions, post them in the chat.